Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Today we are taking a really deep dive into something that honestly sounds a bit bizarre on paper, especially if you're just looking at it from an everyday American perspective.
Yeah, it really is a massive contradiction when you first look at the numbers.
Right. So based on recent analysis coming out of the Lujiazui Forum in China, their economy is dealing with a pretty severe contraction right now. I mean, their property market is tanking. Everyday consumers are just, not spending money. But their central bank, the PBOC, is completely refusing to cut interest rates to help them out.
Exactly, which goes against pretty much every traditional economic rulebook out there.
Yeah, exactly. So instead of slashing rates, they're quietly changing the entire plumbing of their financial system. And for anyone watching global markets right now, especially, with President Trump in office and U.S. trade policy constantly reshaping how global supply chains work, understanding what China is doing under the hood is just super critical.
It's vital. I mean, they are completely abandoning a playbook they've used for decades. And to understand why, you kind of have to look at how they built their economy in the first place.
Right. So let's look at the data we have and break down this new playbook.
Yeah.
Historically, the Chinese economic miracle was built on managing the sheer quantity of money. Like the central bank would basically use a massive financial fire hose.
A fire hose is the perfect way to describe it. They used what economists call window guidance, which it sounds really polite.
That's a yeah.
But it basically meant the central bank would just call up the huge state-owned banks and say, okay, you have strict quotas. You will lend out 50 billion yuan this month, and it has to go to these specific, infrastructure and real estate projects.
And to be fair, I mean, that volume-driven approach is what built modern China, right? It built the high-speed rail, the massive airports, those giant megacities.
Right, it got the job done. But it is incredibly blunt. When you just force that much money through the pipes purely to hit a quota, a lot of it ends up funding, well, really inefficient projects.
Like those famous ghost cities we've all seen pictures of.
Exactly. Ghost cities or these property developers taking on just wild amounts of debt. But what this latest analysis highlights is that the PBOC is officially putting that fire hose away. They are shifting from managing the quantity of credit to managing the price of money.
Okay, so let's translate that for someone who doesn't have an economics degree. What does managing the price of money actually look like?
It means they are tightly controlling short-term interest rates.
Right, so to use a sort of everyday household analogy, it's like they're upgrading from that blunt fire hose to a highly precise smart thermostat.
I like that, yes.
According to the forum announcements, they're tightening control over their overnight rate. That's just the cost for banks to borrow from each other for a single day. But how do you actually enforce a smart thermostat across an entire economy?
Well, they do it by building what's called an interest rate corridor. So think about how the climate control works in your house.
Good.
You set a target temperature, right? If the house gets way too cold, the heat automatically kicks on. If it gets too hot, the AC kicks on. The central bank does that exact same thing, but with borrowing costs.
Okay, so what's the heater in this scenario?
The heater is the floor. It's the interest rate the central bank pays commercial banks to just park their extra cash overnight. If market rates drop below that floor, well, banks won't lend to each other. They'll just safely park their money at the central bank instead.
Right, which naturally stops the rates from falling any further.
Exactly. And the ceiling, the AC, is the rate the central bank charges for emergency cash. Because no bank is going to borrow from another bank at some crazy high rate if they know they can just go straight to the PBOC and get a guaranteed ceiling rate.
So by having this tight corridor, the cost of money becomes super predictable. And that brings their system much closer to how, the U.S. Federal Reserve operates.
Yeah, it's very Western in its mechanics. It provides stability. When banks and big asset managers know exactly what money will cost tomorrow, they don't panic.
Right, they don't hoard cash.
Exactly. The whole system just runs smoother. But making that upgrade is a massive, massive structural shift.
Which naturally leads to the elephant in the room.
Yeah.
If, like we said earlier, property developers are going bankrupt and consumers are tightening their belts, why bother rewiring the whole house right now?
That is the billion-dollar question.
Right. Because if you look at the economic data from May 2026, property investment plummeted by a staggering 16.2%. Retail sales, which is just everyday consumer spending, actually dropped by 0.6%.
Yeah, the numbers are really rough.
And the textbook response to those numbers, like if the U.S. Federal Reserve saw those numbers, they would slash interest rates to the floor immediately, right? They'd flood the market with cheap money.
100%.
But the PBOC kept their benchmark lending rates completely frozen at 3.000 and 3.50% in May. They just left them alone. Why let the market bleed like that?
Because the Chinese economy has essentially fractured into a dual economy. The old engine, which is real estate, and remember that used to be like a quarter of their entire GDP.
Wow, a quarter. That's huge.
Yeah, it was massive. But that engine is fundamentally broken now. Slashing rates won't fix it because it's a crisis of consumer confidence, not a lack of cheap loans.
Right, and that comes down to how people actually buy houses in China, which is very different from the U.S. Most real estate over there is sold through a pre-sale model.
Right.
So you take out a mortgage and you start making payments on an apartment before the building is even constructed.
Which requires a lot of trust.
Exactly.
Yeah.
But over the last few years, all these giant developers collapsed, and they left behind literally millions of unfinished apartments. So the average home buyer is just terrified.
And if you're terrified, it doesn't matter if the central bank drops your mortgage rate to 0. If you think there's a real chance your apartment will never get finished or that it'll lose 20% of its value the second you move in, you are not signing a 30-year mortgage.
You're just not doing it. Economists call it pushing on a string, right?
Yeah.
You can make money cheap, but you can't force a scared consumer to actually borrow it.
Exactly. And here is where it gets really dangerous for the PBOC. If they ignore that reality and turn the fire hose back on anyway, all that newly printed cash has to go somewhere.
Right.
And if regular people aren't buying houses and businesses aren't building new factories because nobody is shopping, the banks just end up sitting on mountains of cash.
And banks hate just sitting on cash.
They hate it. So what do? They take all that money and flood it into the financial markets. The data shows this is a huge fear for the PBOC right now. If they slash rates, banks will just aggressively buy up super safe government bonds.
Oh, I see, because they need a safe place to put the money.
Right, but that massive demand drives bond prices way up to these artificial highs and crushes the yields. You basically create a giant speculative bubble in the bond market without actually helping the real economy at all.
Okay, so that's why they freeze the rates, to avoid the bond bubble. But you mentioned a dual economy. So if real estate is the broken half, what is the other half?
The new engine. So while property and retail are shrinking, advanced manufacturing and technology are booming. Industrial production was actually up by 4.5% in that same period.
Okay, so the government is heavily prioritizing things like artificial intelligence, electric vehicles, and semiconductor manufacturing.
Yes, exactly. They are trying to take an economy of 1.4 billion people and pivot away from just pouring concrete and move it toward high-end tech.
And that explains the smart thermostat. They need this highly targeted drip irrigation system to fund the new microchip plants without accidentally flooding the bond market or, reinflating the dying real estate bubble.
You nailed it. But, and this is a big but, domestic plumbing only solves half their problem. To fund a massive transition like this, they need global capital.
Right, they need foreign money.
They need international investors and foreign central banks to trust them and buy Chinese debt.
Which, I gotta say, has to be a really tough sell right now. I mean,
Yeah.
if you're an American or European investor looking at property investments dropping 16%, you're probably going to hesitate before parking billions in Chinese bonds. So how is the PBOC convincing the world to buy in?
Well, this brings us to one of the most interesting structural announcements from that forum. To get that foreign capital, the PBOC introduced a brand new tool. It's called the FEMA RMB repo.
FEMA RMB repo. Okay, that sounds like intense financial jargon.
It does, yeah. It stands for Foreign and International Monetary Authorities Renminbi Repurchase Agreement.
Yeah, let's strip the jargon away, because a repo is actually a pretty clever mechanism when you break it down. So imagine you manage a foreign sovereign wealth fund, and you own billions of dollars in Chinese government bonds.
Right.
Those bonds pay you a nice yield, but they aren't liquid cash. So if a global crisis suddenly hits, and you desperately need cold, hard cash to stabilize your own country's currency, what happens?
Well, normally you'd have to sell those Chinese bonds on the open market. But if there's a crisis, everyone is panicking. Everyone is selling at the exact same time.
And there are no buyers.
No buyers at all. So the price of the bond absolutely tanks. You're forced into a fire sale, taking a massive loss just to get the cash you need to survive.
It creates this awful doom loop, right, where falling prices trigger more panic selling, which makes prices fall even more.
Exactly. And the FEMA repo facility is designed to just completely short-circuit that doom loop.
Think of it kind of like a VIP pawn shop for global central banks. The PBOC is essentially saying, hey, during a panic, please don't sell your bonds on the open market and crash the price. Just bring them to us.
Right, you hand over the bond as collateral.
Exactly. And we instantly hand you the yuan cash you need to survive. Then, once the crisis is over, you pay back the cash with a tiny fee, and we give you your bonds back. The bond's value doesn't crash, and you get your emergency cash.
It's brilliant because it fundamentally changes the risk for anyone holding Chinese debt. The biggest fear with emerging market debt is getting trapped. By providing this guaranteed backstop, they make holding Chinese bonds significantly safer.
And it's actually a direct copy of a playbook the U.S. Federal Reserve uses to provide dollar liquidity. They're using our own tools to build trust in their currency. The analysis also showed they're expanding offshore yuan trading hubs. It really paints a picture of a country aggressively trying to make the yuan a global reserve currency.
It does, but we have to be realistic here. These are big upgrades, but the yuan isn't going to dethrone the US dollar tomorrow.
Right. Why is that?
Capital controls. To be the world's unquestioned reserve currency, money has to flow in and out of your borders with absolutely zero friction. Total legal predictability.
So if a Wall Street asset manager wants to pull $10 billion out of the U.S., they just click a button and it's gone.
Exactly. But China's system doesn't allow that. The government keeps strict, centralized control over capital leaving the country to prevent capital flight. You can't be the world's primary bank account if the bank manager sometimes locks the vault doors from the inside.
Right, that makes total sense.
Yeah.
So if they aren't trying to replace the dollar entirely, what is the actual end game with this FEMA repo stuff?
The data points to a strategy of insulation. They want to build a parallel financial ecosystem, mainly for trading with partners in places like ASEAN, the Middle East, and Africa.
Got it.
By making the yuan really stable and offering these safety nets, they lower their reliance on the U.S. dollar system. It's more about protecting their supply chains from potential U.S. sanctions or geopolitical shocks than, a hostile takeover of global finance.
Okay, so bringing this all home for the everyday person. If you're listening to this and you've got a 401k or you hold some emerging market ETFs, how does this shift from the fire hose to the smart thermostat actually affect your portfolio?
The biggest takeaway from the analysis is that you have to reset your expectations about Chinese stimulus. For 20 years, whenever the economy wobbled, investors just expected the PBOC to deliver a sugar rush.
Right. They'd print money, start a real estate boom, and global commodity prices would just go crazy. I mean, you used to see the price of copper spike just because the PBOC put out a press release.
Exactly, because everyone knew millions of tons of steel were about to be poured, but that era is definitively over. If you're waiting for a massive policy bazooka to make Chinese stocks explode overnight, you are misreading the new playbook.
It's all about small, precise, targeted adjustments now.
Huh.
But capital never sleeps, right?
Right.
If the money isn't flowing into real estate anymore, where exactly is the smart thermostat directing it?
They're trying to engineer a massive shift in household wealth. For decades, the only way a Chinese citizen built wealth was by buying a second or third apartment.
Right.
Now, the government desperately needs those savings to go into the stock and bond markets to fund the new tech engine.
Which points investors right to the sectors, getting that drip irrigation. Based on the analysis, the money is flowing heavily into AI infrastructure, advanced robotics, electric vehicles, and semiconductors.
Yes, those are the strategic priorities. And conversely, the data suggests extreme caution with the old economy. Real estate, local government businesses, general consumer goods, they're facing huge structural headwinds.
Yeah, totally vulnerable until consumer confidence comes back. Now, there's one final super important mechanism from the forum that we have to talk about. We talked about the PBOC creating a safety net for foreign countries with the repo, but they're also expanding their safety net domestically to include non-bank financial institutions.
This is huge for their internal market stability. Central banks normally just backstop traditional banks. But in China, massive power has shifted to these non-bank entities.
Like the massive brokerages, private equity firms, asset managers, basically the Wall Street equivalents in China.
Right. They manage trillions of yuan, and they are all interconnected. If a giant asset manager defaults because some tech bets went bad, it could cause a cascading panic.
So to stop that, the PBOC announced they are actively building emergency liquidity tools specifically for these non-banks. A formalized safety net so one failure doesn't crash the whole system.
It sounds incredibly responsible, but
There's always a but.
always. It introduces a massive psychological distortion into the market. It creates moral hazard.
Right, moral hazard. Let's explain that for the listener because it's such a crucial concept.
Yeah.
Think of moral hazard like a teenager who gets a credit card from the rich parents. If the teenager knows the parents will always pay off the bill no matter what, they are going to spend way more recklessly than if they had to pay it themselves.
That is exactly what happens on a trading floor. If you manage a massive Chinese brokerage, your goal is high returns. Normally, the fear of bankruptcy stops you from making a crazy, highly leveraged bet on some new AI startup.
But if the central bank is publicly promised to bail you out with emergency cash so the system doesn't crash, your risk calculus completely changes.
You are heavily incentivized to take the reckless bet. If the startup succeeds, your brokerage makes billions and you get a massive bonus. You privatize the gains.
But if the startup fails, the central bank steps in, saves you, and passes the cost of your failure onto the public balance sheet. You socialize the losses.
The PBOC knows this is a problem. Their announcements say they are trying to design these tools with strict penalties attached so that using the safety net is painful enough to discourage reckless bets.
But balancing that scale is so hard. Even the U.S. Fed struggles with it. By expanding the backstop, the PBOC is trading the immediate threat of a crash for the long-term risk of giant state-funded speculative bubbles.
It's a very precarious tightrope walk. They're trying to deflate a real estate bubble, pivot to high-tech, internationalize their currency, and manage the daily price of money all at the same time.
Which really brings us to the core tension of this whole deep dive. According to the research, China is aggressively adopting the really sophisticated, market-driven mechanics of Western central banking. They're building interest rate corridors and global repo safety nets.
Yeah, structurally, it's very modern.
Right. But at the exact same time, they are maintaining rigid, centralized control over capital flows. They want the efficiency and trust of a free market, but they are completely unwilling to actually grant the freedom that makes a free market work.
Right. They want to control the outcome from the top down.
Exactly. So the fundamental question moving forward, the thing you at home should be watching closely as it impacts your portfolio in global trade, is this. Can you successfully run a fully modern, globally trusted financial system with only half the freedom? It is an unprecedented macroeconomic experiment, and how it plays out will probably define the next decade of global economics.
It absolutely will. The mechanics have fundamentally changed, and we are all going to feel the ripple effects.
Don't forget to subscribe and hit that like button.